Hello and welcome to Money Maximized. Today we are going to talk about the dynamics of inflation. Inflation, the persistent and general rise in the prices of goods and services in an economy, is caused by a combination of various factors. These causes can be broadly categorized into demand pull inflation, cost push inflation, and structural factors. Here's a more detailed explanation of each. Demand pull inflation. Demand pull inflation occurs when the aggregate demand for goods and services exceeds the economy's ability to produce them. This can be triggered by consumer spending. When consumers increase their spending due to improved confidence, higher income, or reduced taxes, demand for goods and services rises, potentially outpacing supply. Government spending. Government expenditures on public projects, welfare programs, or defense can boost demand, leading to inflation. Investment. Increased investment in businesses, infrastructure, or capital goods can also fuel demand and push prices upward. Exports. If a country's exports surge, it can drive up demand for domestic products, potentially causing inflation. Cost push inflation. Cost push inflation occurs due to rising production costs, which are then passed on to consumers. Key cost factors include rising wages. When wages increase for workers, businesses may raise prices to cover higher labor costs. Increased input costs. Higher prices for raw materials, energy, or other inputs necessary for production can force businesses to increase their selling prices. Taxes and regulations. Increased taxes or new regulations that increase business operational costs may lead to higher prices for consumers. Structural factors. Structural factors relate to changes in the economy that impact prices in the long term. These include monetary policy. Central banks control money supply and interest rates. If they print excessive money or maintain low interest rates for an extended period, it can contribute to inflation. Fiscal policy. Government fiscal decisions, like budget deficits or surpluses, tax policies, and public debt, can affect inflation. Exchange rates. Changes in the value of a country's currency relative to others can influence the cost of imported goods and impact inflation rates. Supply chain. Disruptions. Disruptions in supply chains due to natural disasters, geopolitical events, or other factors can limit the supply of goods, leading to increased prices. Market power and monopolies. Firms with significant market power can control prices, resulting in inflation when they decide to increase prices across the board. Understanding the interplay of these causes helps policymakers, economists, and individuals anticipate, manage, and mitigate the impacts of inflation on an economy. Thanks for watching, and don't forget to like, share, and subscribe.